In this week's AMT Insight, I'm going to be discussing the market for everyone's least loved battery metal, and of course I'm talking about lead. Now, in spite of the price correction that we saw last week, the LME price has managed to overall rally pretty well since June, while Shanghai Futures Exchange lead prices have continued to lag their counterparts' gains. Now, if we look at LME spreads to begin with, we can see that the price has been driven higher really by very clear signs of physical tightness in the ex-China market. So you've seen that LME nearby backwardation really spiking out, particularly over the last couple of weeks. And really that's been associated with very consistent and strong LME cash buying interest. Now, that backwardation has eased off a bit over the last week, and that's really been associated with significant lending interest over the Audex index fund roll period. So that was a big period of funds rolling their positions, and that drove some weakness in the spread, and that may have fed through to the LME price correction we saw over the same period. Now, really what's driving that physical tightness though, and that tightness in the nearby spreads, well, you can see that inventory drawdowns on the LME have been quite substantial over the last month or two. So you can see that LME registered warehouse inventories in Europe fell to a 14-year low, and that's really been, Europe has been where the drawdown in inventory has been most concentrated. Now, what is the reason for that, I think, which is the pivotal point? Well, we can see that from the chart, US refined lead imports have picked up quite substantially so far this year. And it's been reported that by CRU that Glencore were taking delivery of LME metal in warehouses in Europe to re-refine that and then ship that to the US. Now, the US market has been so tight because demand has been so persistently strong since the start of this year, and premiums reflect that as well, physical premiums. And part of the factor behind that, associated also with the strong demand, has been the closure of the recycler Clarios in March. So that has been a drive behind this demand for imports that we've seen so strongly from the US. Although European demand has also been pretty solid, and Europeans had its own supply difficulties in recent weeks. The key one really being the flooding in Germany, which hit Berzelius-Stolberg, which is a 155,000 tonne per year lead recycling plant. Really impacted production there. They had to declare force majeure, and it's likely to be at least a few more weeks, at the very least, before that returns. So some supply issues there in the European market contributing to that ex-China tightness, along with this US tightness that I've discussed as well. I think other than that, on the European side, the issue is that you have very ample scrap supply, but the smelters have very full order books and are operating almost at full capacity, apart from Stolberg, which I mentioned. So lots of kind of difficulties with meeting the demand requirements outside China. Now, moving to China, I think this is the really interesting story really in the lead market, is the real dichotomy and contrast between the ex-China market and inside China. So in China, we've seen very significant signs of heavy oversupply. You've seen Shanghai Futures Exchange stocks rising to an all-time high since the contract started in 2011, and the market in China for the Shanghai Futures Exchange lead contract is in contango as well. So physically, what's really been behind that? Well, you've seen lead-acid battery demand in China, I guess, disappointing from earlier expectations earlier this year, and the expectations that drove a lot of restocking in the supply chain earlier this year. And I think that high stocks in that supply chain and an unwillingness to restock lead or at a time of high lead prices has been a key factor as well. I think if you're also looking at the outlook for China and the path for demand growth in the coming months, now the bigger story, the macro story, is that they've had to implement a lot of strict measures in China to contain this recent virus spread in the country, and that's something that may also weigh on consumer demand and spending, and also therefore by proxy weigh on lead demand prospects a bit as well. On the other side of the coin there, for China, you've had the supply story, and really that's been a story of very strong production growth in recent months and indeed the whole of this year, really. So that's been driven by very strong margins for smelter production growth, also helped by the byproduct revenues that a lot of primary smelters are getting, aside from the lead that they're producing, so things like silver, for example. And then secondary capacity additions, investment in that recycling capacity has also been a key driver as well. And overall, you've seen China's second quarter output of lead about 180,000 tonnes. So that was up around 2% on the quarter and 15% year on year. So very strong growth in supply there. And that's really been contributing, along with that subdued demand, to this big rise in inventories and oversupplied market conditions in the country. Now, where does that leave the outlook for prices and for the market in the next few months? Well, I think one thing you can see really because of that difference between the LME and Shanghai has been the widening premium of LME to the Shanghai Futures Exchange prices, albeit that did pull back a little bit last week with that correction we saw on the LME. Overall, the global market remains in just probably limited oversupply at the moment, but we've seen, as I've explained, that glut is very much concentrated in China. And I guess the reason why we haven't seen a rebalancing of that global market yet through Chinese lead exports, and a key story really is that the shipping costs and delays that we've seen globally, affecting multiple markets for goods globally at the moment, have really made it very difficult for arbitrage traders to balance that out by shipping lead out of China to where it's needed, namely Europe and the US. Now, what the implications is that I think LME prices are going to stay pretty well supported because the ex-China fundamentals are so strong at the moment. But it is very clear that oversupply in China has that continued and persistent threat of exports, and that's going to remain an ongoing risk to LME prices. And I think really where we might see that is if LME prices are independently trying to push higher again, maybe you're going to see some arbitrage related selling that starts to come in that weighs on that, or there's a perception amongst investors and the physical community that is a risk, and that might restrain price performance a little bit as well. Now, if you've enjoyed these insights that we've been putting out weekly for the last couple of months or so, really encourage you to follow AMT on LinkedIn and Twitter. You can see the details above me right there. And that would really help in terms of us measuring the impact and the usefulness of this content we're putting out. So very much encourage you to doing that. Thank you very much for listening, and I will catch you next time.